Good evening, everyone, and welcome again to our Q3 Market Outlook. My name is Patrick Chang, and I'm the Chief Investment Officer for CIMB Bank. I want to basically just give you a snapshot of what's happened in the last quarter, but essentially, it's been a very exciting quarter to say the least. If you dial back what will happen when we said in Q2 itself that beyond the noises of Trump 2.0, we want to share with you our views on Trump 2.0, and our heading today should be about beyond tariff tantrums. Now, if you fast forward in the last close to 90 days since April the 2nd, basically, Donald Trump has come out with a pause in terms of the tariffs. We are now at the eve of that pause, and as we speak, it may be postponed till August the 2nd. What bodes for markets going forward, despite the fact that tariff uncertainty continues, and the fact that basically we are still in a very uncertain world in geopolitical terms. Without further ado, let me introduce my colleagues. Boon Ho on my left, team lead for fixed income. Diana on my far left, team lead for equities. And we want to discuss a few key topics that I think are very relevant at this juncture itself. Without further ado, based on what we know today, Boon Ho, we have been talking about tariff tantrums for the last close to 90 days.
Yep.
Which means, basically, I get the sense that investors out there are actually quite tired of listening to Donald Trump tweet, talk, and basically cause a lot of uncertainty.
Sure.
In light of the changes that we've seen in the last 24 hours or so, what do you expect out of the trade tantrums that we are seeing going forward?
I think eventually markets will actually sort of like discount and not overreact because it has been what we call a wild ride. But eventually markets have been quite calm despite the latest announcements about higher tariff coming on board on the early August. So I would take about this is that basically I think markets need to adjust to the new reality. So it will be probably a one-off adjustment, and then they will get used to it, and then things will still carry on based on fundamentals.
So are you basically saying that the markets are calling the bluff on Trump? In other words, people would rather ignore tariff uncertainty, which is you and I know that it can flip flop either way. One day it was 145%. Today is down to close to between 10 to 20%. So are markets, in your mind, too complacent about tariff uncertainty, or do you expect this tariff uncertainty to cause business confidence to wane, as we've seen recently, consumer confidence also to wane, and maybe to a certain extent, the overall markets taking a cue that things will start to slow down a little bit, maybe in the second half?
I think a lot of the shock and awe already happened in Liberation Day. So as we move away from there, 90 days and beyond, I think things will start to taper down. So markets probably would not react that crazily as what we have seen after Liberation Day. Whether market is very complacent or overly complacent, that remains to be seen, because that largely depends what Trump or the US government will announce moving forward, how they will actually do that adjustment towards the tariff eventually coming agreement.
Right.
Yeah.
Now, there's a school of thought out there that suggests basically that with all of these uncertainties that we've seen, investors out there are starting to get very more wary about US assets, whether it's equities or fixed income and the likes, right?
Sure.
In other words, potentially US exceptionalism could be fading, right? Mm-hmm. Do you agree with that kind of, I think getting quite consensus today?
Yep. I think a lot of institutional investors especially are very concerned, and they're taking action diversifying away from the US dollar to other currencies, including alternatives like gold. I think the major currencies that benefit are euro, maybe a bit of Japanese yen, British pound, even closer to home, the Sing dollar, even ringgit. So those currencies would continue to actually benefit. But I want to caution that I think the slide in the US exceptionalism, I think it's reaching a slow burn rather than a rapid decline, because there's still a lot of percentage of the reserve currency still parked in US dollar.
Right.
Yeah.
I mean, it's quite exceptional to hear or to see even that the US S&P 500 today is close to all-time high, or was all-time high a couple of days ago. And yet people question this US exceptionalism. What are your thoughts on this, Dinah?
Yeah, I think for me, the US exceptionalism is not really fading, but I think it's being challenged. Yeah, so I mean, this is seen in two areas, right? Like in the area of AI, tech, and innovation. Well, I think the US still has a strong lead. And secondly, it's like it has deep capital markets that are very liquid. So I think in these areas, the US market is still very unrivaled. And this is seen in the S&P 500's performance, like you mentioned, right? All-time high. I think what we grapple with, right? We have a neutral rating on the US. What we grapple with is valuation. It's really at 22 times PE. It's close to the peak, right? So I think what we are questioning is how sustainable is this? So for us, the key would be the tech sector earning. So as I mentioned, all the Magnificent Seven stocks, the earnings are still very strong, about 28% year on year in first quarter compared to the rest of the market. So I think we'll be watching this closely to see if this rally can sustain.
But back to this whole topic about US exception, Boon Ho. So Treasury market itself is biggest asset that is owned by central banks and large pension funds and large institutional clients, as you mentioned early on, right? Given the fact that people are starting to question the fact that this big, beautiful bill that was just announced, this tariff uncertainty and so forth, right, are causing people to question whether clients or whether they should be holding on to dollar asset itself, right?
Yes, right.
Is this something that we should be worried about when it comes to fixed income on the US Treasury particularly?
Okay, so this angle of concern mainly stem from the dollar weakness we have seen has depreciated about 11% year to date. I think it's causing a lot of people to actually wake up and have a look at whether they should actually keep their assets more diversified instead of only focused mainly on US dollar. So we have been advising our clients to diversify, for instance, the bond portfolio into currencies which are probably a bit more undervalued now, like Aussie dollar, pound, and also retain some US dollar, because US dollar is still quite a major currency in the world in terms of trade and also reserve currency. And I think safe haven currencies like Sing dollar and euro, maybe even some ringgit, could actually help diversify some of this currency volatility moving forward.
But the dollar move today at about 11% on the DXY is not something that one should be taken lightly, right? I mean, history has shown it hit a high of about 108. Today is about close to 97.
Yep.
It's a very massive kind of support levels that we see today.
Sure.
Euro is rallied by 13%, and the list goes on, right?
Yeah.
And even, ASEAN currencies across the region have also benefited from this, right? So are we basically saying that even though there is a slow burn in terms of the US dollar itself, do you not think that this whole thing do you not think that people should be more worried that the depreciation should actually accelerate even more going forward?
Yeah, in order to guard against that risk, it shouldn't be taken lightly, definitely. In order to guard against the risk, we actually advise clients to start acting diversifying away from the dollar now, instead of waiting for later.
All right, okay.
Because based on our CMB Treasury forecast, dollar could still go down. Maybe the DXY could go down to be about 95. But who knows? If Trump announce something shocking, it may go down faster. So we cannot take that light.
Well, anyway, Trump basically has always mentioned that he wants a weaker dollar. We don't know what that weaker dollar really means, right? But effectively, he wants a weaker dollar because he wants to make America great again by essentially moving manufacturing and investments into US, right?
Yeah, hence the other downside is, of course, if weaker dollar means eventually Fed will need cut rate in order to make the dollar weak. They cannot keep the interest rate high. And that also plays into the Trump wish list that basically he wants borrowing costs to be cheaper to help business support pro-growth. And that also actually support the case for bonds markets to actually be more positive outlook.
Right.
Yeah.
Yeah, hold that thought for a while, right? So I think you hit it on the nail, right? You got a weaker dollar exacerbated by policy uncertainty and tariff uncertainty. You got a potential for the Federal Reserve cut rates by, I think, two rate cuts this year, it doesn't, right?
Expected.
So given all of that, it does sound that the dollar should be weakening faster than expected, no?
Yeah, as I said, we shouldn't take it for granted. So it's time for clients.
So diversification should be key.
Correct. I think that should be the top of the agenda, clients' mind or customers' from
Right.
this point. Right.
Diana, so in light of all this, US markets being, like you said, not very cheap, exceptional being kind of undermined in the shorter term, so to speak. How do you see Asian equities going forward?
Yeah. In light of the weaker dollar, we are seeing like global rebalancing with funds flowing Asia. So in our third quarter outlook, we have this theme called the Asia Renaissance, right? So I think like if you look historically, Asian markets tend to outperform when dollar is weak. So within Asia, we have overweight on Hong Kong, China, neutral on India, and neutral on ASEAN. Yeah. So I think our overweight call on Hong Kong, China is mainly because, it has been quite persistent, as in like resilient in the face of even higher tariffs, right? When we saw tariffs going to 145%, it did, but then, it stayed relatively resilient after that. There's also the AI renaissance, with the advent of DeepSeek in the first quarter. We think that will still give the structural tailwind for Hong Kong, China.
And Hong Kong, China is already up by close to 19% year to date. Yeah. Asia is up by 13%, right? Mm-hmm. So, based on history, Asia tends to be a one-hit wonder, right? We've seen that before. Hits one couple of months and then people kind of, it kind of fades away, right? Yeah. So what is the major catalyst or driver of this whole Asian renaissance that you're looking at?
Yeah, I think this time we feel like it's quite different. Okay, previously, like the flows to Asia, like you say, more short-lived, more like sentiment-driven. I think this round, we see it as more like structural. There's more like improved fundamentals. So I think what we mean is that, for example, we look at China, right? It's more prepared in Trump 2.0. It has shifted from depending on the old economy, things like property, infrastructure, and now it has pivoted to new economy like AI, tech, tech self-sufficiency, robotics. So we have seen this shift, as well as there's a lot of share buybacks. The government has asked a lot of companies to share buyback. There's a surge in IPOs as well, driving liquidity, and we are seeing the southbound flows from the mainland China, going to Hong Kong market, and that is like over 90 billion in the first.
But one should not equate, having this bullish view on Asia just on premise on China, right? I'm sure there are major other drivers of other countries are so kind of more resilient or doing much better than they are, right?
Yes, yeah, absolutely right. I think we want to drive across that our overweight on Asia, it's not just on Hong Kong, China. Even though it's a big part of the regional indices, we still have markets like India, where we have a neutral call. And India as well is a good diversifier from China, right? You see that it has a population growth, it has low correlation to other markets, it's very domestic driven. So this helps, in the midst of volatility. It's also a beneficiary of China +1. And, not forgetting we have the ASEAN markets where we...
So I want to challenge you here, right? Historically, Asia had been cheap for a reason, right? But this time around, it's also cheap. And if I hear it correctly, it has improving fundamentals, right? If you combine all that together, what you're saying is that this is a region that is resilient, is growing, and is basically well prepared for Trump 2.0. Is that a good summary of what I think about Asia Renaissance?
Yeah, I think in general, compared to last time, I think that, the supply chains are already well diversified. Asia is prepared. You can see that even today, with the new tariff letters from Trump, the markets are relatively new.
Yeah, I was quite surprised at that. Right? I mean, exactly. I was looking at my screen today. Yeah. Basically, Hong Kong market, Korean market. I think Korea is up by 1.8% today. So it sounds. I mean, after getting all those kind of love letters from Trump, right?
Yeah.
Okay, good. What about ASEAN nearer to home? Malaysia, Singapore, and the rest of our neighboring countries.
Actually, ASEAN has not been doing as well. I think year to date, most of the markets are negative, except for Singapore, so only positive. And I think the main reason is because, of all the tariff uncertainties, right? because these ASEAN markets, they are very export dependent. So all these tariffs have caused policy uncertainty, and the growth for the first quarter has quite slow. Yeah, so I think because of that, we're seeing it underperform. Yeah, I think the only overweight we have is on Singapore market, where we see it as a relative safe haven. Yes.
But it's all-time high,
Yeah, we understand because, it's a safe haven.
I hate to say this, but this is the most boring market on the planet, but it still outperforms.
Yes, I think our team is, we said boring is beautiful, right? In this phase of volatility, and you have seen it outperform, right? And I mean, in the midst of all these noises, I think Singapore gives very good dividend yields. The market gives like over 5% dividend yield. If you compare to the bond yield, it's only 2%, right? So there's a good yield pickup from there. It also gives policy stability, strong currency, and the US has a trade surplus with Singapore, right? And the relative tariff on Singapore is about 10%. It's lower than ASEAN markets. So I think that they have merits, for our overweight on Singapore.
Okay. And what about your home market, Malaysia itself, which I understand you downgraded to neutral recently?
Yes, we downgraded to neutral, mainly on valuations, right? So it hasn't done so well in the first half, down 7%. Several reasons for this, like after a very exciting last year, with data center investments, the SEZ announcement, things have slowed down in terms of news flow, mainly because of tariffs as well, right? We have all the AI chip stuff like that. Yeah, so secondly is the first quarter result season, was weaker than expected.
But if you had to look away from this quarterly stuff, which, is too short term, right? Would you say that basically all of the ASEAN markets could be a bit more interesting going forward?
Yeah, you're right, because, it has been so bashed down. So I think for Malaysia, that's why we have neutral. I mean, we're not saying that things will not improve from here, right? A lot of it will depend on the trade negotiation. We were rather quite disappointed today, like, we thought that the tariffs would go down, 10% after negotiations, but it has, gone up in. But this is something that can change. Yeah. So, and second thing to highlight is that, foreign shareholding in Malaysia is already quite low. And, the ringgit has been strong. So these are some of the catalysts that we can look forward to. Yeah.
Okay. Do you share the same view of a kind of more bullish equity view on ASEAN? I mean, despite the fact that, I just wanted to hear your view on a fixed income point of view of, do you share the same view that this is the renaissance of Asia in the 21st century, even despite the fact that Trump is going to Trump is going to be the biggest havoc maker for Asia?
I think from the interest rate, which drives the bond market perspective, of course, it's been very stable. Right to the developed market.
I was just surprised.
And US.
The Asia one index is up, 6% year to date, right?
That's right. That is driving one of the main drivers. And of course, in terms of currency strength, we have seen, appreciation, like the ringgit has appreciated about 6% against the dollar, which is good. But I don't think it will have that type of pace of appreciation moving forward. So I think taking a more measured approach is palatable, because we are still quite neutral on Singapore and Malaysia, because we think a lot of the positive has already been priced in. And yields are not really that great, maybe about 4-ish%. So you can diversify some into Malaysia and Singapore market, for instance, but that is on the basis of the neutral.
Right.
Yeah.
Well, ladies and gentlemen, we have covered the whole big discussion about US exceptionalism. And our view is that the dollar, and in terms of US asset sales, will probably slowly decline over time. History has shown that the decline itself is a very gradual one. So do not worry. But obviously, at the end of the day, our mantra is about global diversification. And so I want to touch on a very key point out there that we mentioned in the last quarter itself. And that is how to build a global diversified portfolio. And I wanted to reiterate a few key points, which I want to touch on very, very quickly. And that is on income itself. Now, you're a fixed income person. Obviously, when you look at fixed income itself, there are obviously other kind of assets that also are generating quite decent income, right? Apart from equity income. When you combine that to a equity portfolio itself, do you expect this volatility of the total portfolio to actually increase or decrease?
Well, if you take income component into the element of the portfolio, definitely it will be a stabilizer for the portfolio performance. Let's say you can derive maybe about 4 to 6% from a bond yield, or even 4.5% from a dividend yield. That actually can stabilize the portfolio. But the added advantage is, of course, we have a third pillar, which is what we call the covered call options, where you can derive maybe close to 6 to 7% from both combination of selling covered calls, getting premium, and also some dividends.
So how do clients get exposure to this to get this additional income that becomes a stabilizer for your portfolio?
So the good news is that a lot of this style of strategy already packaged in some funds we already have down. So if you want more details, of course, can approach the relationship managers. But what I trying to make another point is that, of course, a lot of this strategy also involve lower beta or lower volatility. So if you look from the perspective of upside, of course, it is less. But if you look perspective of downside protection, in terms of a drawdown in the equity markets potentially in the near future, then that this strategy actually plays well with that down.
I suppose for the benefit of the audience out there, in simple language, it really means that we're trying to provide or advise customers to build a global diversified portfolio.
That's right.
With income that generally reduces the volatility of your fund, whilst you clip income as you go along. You all right?
Yep.
Okay. Then what about gold? So gold has been a very interesting trade, and I would say interesting trade. It's now being core part of portfolio, right? We have about 5% asset allocation into our asset allocation, right? And that has done very well. It's up by 27% year to date, right?
Yep.
And still going up. So where do we go from here on gold?
I think gold will still receive a lot of the positive outlook moving forward, driven by two, because dollar is depreciating. Usually you provide a tailwind for gold. The other one major factor is, of course, a lot of the central banks are still adding gold positions. So by the demand forces, it can actually keep gold prices high. But the word of caution is that we don't want to chase in late. You want to actually wait for a bit of a pullback, maybe about 3250 level before we.
I've been waiting for gold to correct for the last 2 10 months, right? But it has not corrected, So is there really any merit in actually trying to time the market?
I think time in the market is definitely more important than trying to time. So
you suggest
you're already holding gold, definitely you want to hold on gold as a safe haven diversifier. But if you don't have gold, you want to add, I think it's all right to add gradually.
Yeah. Okay, good. I think we are almost top of the hour, but I just wanted to close by asking Diana, since you're new to this game of webinars, and I thought it'd be cheekily enough, I'll ask you a very trick question, and that is, if you had to think about your best idea for the current quarter itself, in terms of markets or sectors, without having to go into stocks, for example, what would it be?
I think it will be on Asia, like we mentioned, right? We're all the way on Asia, and we think that this time could be more like long term, more structured. So definitely, I think a lot of us already have US exposure. So I think a good way would be to diversify in Asia, equities or funds, so that it gives you a bit of diversification, and also it has relatively cheaper valuation.
And what about income?
Oh, well, my favorite is definitely Aussie bonds. And it is actually Aussie investment grade corporate bonds, especially from the insurance and also the financials. So you think about how the returns can stack up. It's like you look for bonds with 5.5% return. And then you add up to some capital gain, because RBA could actually cut rates by 75 basis points this year. That could add another 2.5%. That adds up to 8%. The last kicker is, of course, currency. Aussie dollar is expected to appreciate within the next 12 months, maybe about 2 to 3%. So that could easily hit maybe about close to 10%. So I think that's really attractive.
In fact, actually, the RBA did not cut rates today, and their $5 started rallying.
But that also means RBA could actually need more when the time comes, when the slowdown from all these global tariff, global trade tensions could actually force the hand of RBA to act more forcefully.
All right, thank you very much for that. And ladies and gentlemen, we are almost coming to a close for this current session of the webinar. I just want to reiterate a few key points, three key points. Number one, our view is that yes, US exceptionalism is starting to fade, but I do think that that is going to be a gradual fade, as we call it, and therefore you need to think about diversifying a little bit of your money into non-dollar assets. Number two, we are a big believer that the Asian economies and the Asian assets itself, whether it's equities or fixed income, remains very, very constructive in the longer to medium term. And therefore, you need to start thinking about reallocating into Asia, especially in Asian equities. Last but not least, I do think that in this kind of environment where there are a lot of uncertainties out there, you want to combine a portfolio that combines global equities with global fixed income, and you basically get a derivative called yield, for example, in that portfolio. You then basically mitigate all those kind of risks. And so at the end of the day, I think you need to think about how to stabilize your portfolio in this fairly uncertain world that we live in. Thank you very much for your time this evening. I hope you enjoyed this session. On behalf of the CIO office at CIMB, I want to thank you for your time again. And thank you very much, Dinah and Bunho, for your views on the markets. Until the next session, we'll see you again. Thank you.